Good morning and welcome to Talk Your Chart. My name is Marco Segura and I'm with Brett Horowitz. Brett, how you doing?
Good morning, Marcos. It's been a nice wild ride since we've had our last conversation in the markets. I thought of you a lot since our last episode aired because I watched the movie Howard Stern's movie Private Parts, which I'm sure you've seen thousands of times, being a big movie buff as you are.
More than once.
Yeah. And so what really caught me during the movie was when Howard Stern and Robin start talking off the cuff, right? It's the first time where everyone looks at him going, what are you doing? Why are you talking to her? You're not allowed to talk to her. And they just showed their personalities and showed who they were all about and went off script. And I thought, today, let's try it out. Let's go off script and just talk without having any kind of agenda.
Okay. We'll do our best to keep it as PG as possible, but we'll channel our inner Sterns as we run through the invigorating topics of inflation and whatever you brought to the table today.
Yeah, I mean, it's not like we had a big script last time, but let's see if we can even get less of a script this time and just have more conversational.
Okay, so let's kick it off with inflation, Robin, or I'll be Robin, you can be Howard. So a question for you, Brett Horowitz. Inflation, I'll give you something you know, and then I'm going to ask you the question. Inflation year over year, right? June to June, it's up over or just shy of 5%, right? Depending on what day you choose in June. What do you think inflation is up annualized from June 2019 to June 2021?
If I had to guess, I'd say sub 2%.
Sub 2%. Well, you're wrong, and that's okay. But what's more important is not that it's sub 2, because it's actually 2.6, but it's not the 6% that everyone's looking at right now. You and I know it well, this idea of base effects, but the 6%, almost 5 to 6% reading we're getting in inflation year over year has to do with base effects.
Right.
What's a base effect?
Things like gas going down last year, things like food and energy going down, things like services going down. So all that's weeding off a lower number from last year. It makes sense. It's got to go up for this year.
Precisely. So you're getting that additional reading. It's the same when we look at a balanced portfolio, right? That over the last 12 months, up 20%. We're not anticipating that's going to happen consistently moving forward, but starting off a big low, right? You get these big pops over time. So next question for you. Since the mid 1970s to up to 1980, let's say, inflation, do you think it's ever seen a jump beyond the 2.9%? And I guess more importantly, how often do you think inflation was above average since 1980?
That's the thing. During basically almost my entire life, we've seen low inflation. And even when the government pumped so much stimulus in back in 08, 09, even when we had full employment, we still didn't have high inflation. So I have to wonder, what would cause high inflation? I almost don't really understand anymore what's going to cause it and why it's been so low for so long.
Yep, precisely. And I think that's the headline, as always. We have no idea. Predicting things is really hard. Predicting inflation is very, very hard. So we're obviously not here to predict things. What I wanted to show you in this chart that I found interesting was 1980 to now, all these crazy spikes that people were used to seeing pre-1980, calling our grandparents' inflation metrics, are not the same metrics that we use to gauge inflation since really 1983.
So you're saying the definition of inflation has changed?
The definition has not. The way it's calculated has. So real quick, I'm going to give you three things that sometimes catch headlines, but most of the time don't, right? Because they're probably a little bit too heady, but that I found interesting. So 3 items since 1983. The first one was in actually 1983, and it changed the input into the inflation figure from housing prices to rents. Basically, they stopped looking at what appreciation your actual value of your home had, and instead they asked, what would you rent the house for? And that change in what you would rent the house for was the new input. And that, without a doubt, as you can tell from the graph that we're looking at, began to mute the volatility in inflation.
And was that done, you think, intentionally to lower inflation? Or do you, in your reading, do you know why that was done?
So that's an interesting point. And without a doubt, as you can imagine, there's two schools of thoughts there. right? Because one is saying this is data manipulation and it was done intentionally to reduce the fear that's caused by these big spikes in inflation. The other school of thought is it was being miscalculated beforehand. And these big lofty swings that are really the volatility of inflation, we really didn't need to experience it. So let's get better and improve our tools in the way we measure it. So that's just one item. Two things that I also found interesting: expanded quality enhancements. What the expanded quality enhancement does is basically they're allowed to adjust prices lower for quality increases in your product.
Right.
As an example, the price of a television within the basket of your inflation gauge is down 90% since it first got injected into it. We all know prices of televisions are down, but the actual inflation meter itself has even further depreciated that price because of all these enhancements. So that's obviously going to be a natural downward pressure on inflation volatility.
So a $500 TV, this is what I understand, a $500 TV that was the price 10 years ago. If it's the same $500 TV today, but it's loaded with all this extra stuff, you know, HD and 4D and OLED and all this, you know, it's going
Disney
to show
Plus,
up
all that good stuff.
as depreciate as de-inflation, disinflation.
Absolutely, 100%. The last thing was this idea of product substitution, and specifically an expanded version of product substitution. And this was in 1999, which basically says, if the price of meat goes up, you're going to buy less meat, you're going to go buy chicken instead.
Spam.
So we're going to remove it. Well, yeah, precisely, right?
Have you ever tried
How
spam?
How much spam do you have in your house right now?
I've never tried it. Although my wife seems to like it. She had it in her days
wow.
in Cuba, but I've never had it.
I was about to say it's the Cubans that make it. I know what we're having for lunch now, but that's neither here nor there. So basically, it makes the assumption that, sure, we all do this to some extent, but basically what these people that are putting together this basket of goods get to do is substitute this increased meat product and substitute it with the replacement product, i.e. chicken, right?
Well, we know some
all
people
this
do
is to
that.
say,
Some people do that, right?
absolutely. I do it, right? To some extent, I'll do it, right? Sometimes I won't buy fish. I'll buy a meat or a chicken or a pork because it's less expensive. But the idea that they're doing a blanket substitution and making the decision for everybody, is that right or wrong? I'm not here to determine. All I know, and you can look at it, this chart, since 1983, the volatility, right? The ability for inflation to have these crazy spikes is muted, in my estimation, in part by these three factors that have changed meaningfully. So the question I bring out of this is, are the changes in the way inflation is calculated made it so much so that it's just not going to happen because the way we calculate it is different?
Well, the caveat that they would provide, and I think we would say to all of our clients, is this is not based on each person's unique situation, right? Like you said, it's based on everyone as a whole. And so there's a different CPI for urban living versus suburban versus elderly versus whatever it may be, because the baskets of goods that you were buying or that subset of the population are buying are going to be different, right? And so it's not saying your inflation is 5%. It's saying that on average, you know, this is the population's inflation, even if the number is a little bit different.
Yeah, that's true. We always talk about your basket of goods is different than your neighbor's basket of goods. So that's the point well taken. I think my takeaway to all this is that it's going to be tough to get back to 1970s level inflation. And I think that outlier event is kind of a little bit old economy. And we're just not measuring inflation like your grandparents measured inflation, so to speak. Doesn't mean it can't happen, obviously. I just think it becomes challenging to massage the numbers in a way that's going to create those readings that we saw back in the day.
Well, we all hope you're right. We all hope that times have changed. We all hope the Fed has gotten a better gauge of things. You know, they've been around for a long time, and you just hope that they can tame inflation because the markets clearly want that to happen.
Yeah, absolutely. I think the market signaled that immediately. The 10-year tip break even is now coming down a little bit because I think Biden at least seemed to listen with reducing the price tag on the infrastructure package.
You love to bring up politics. I'm going to go right away from that. You brought up last time, you brought up this time, no politics. Come on.
We'll see.
We don't need half our listeners.
You said honest self, true selves.
Well, let's talk about something in the past where times have changed. You know, we talked about inflation changing. I think I want to pull up a couple of charts on the markets because over time, I feel like, a lot has happened over the last, I think we missed a birthday recently. I don't know if you celebrated it. The Dow turned 125 years old this
Oh
year.
God, the Dow. Oh God.
Your favorite index, isn't it?
Yeah, absolutely. 1896. What else was relevant in 1896?
Well, the point is not that the Dow is the most relevant benchmark, or that taking 30 companies and calling it the market, is really going to be accurate, or that it's price weighted, not cap weighted, whatever the case may be. The point is, if we look at the chart here of the Dow, which had a birthday this year, imagine your great grandparents, 3 generations ago, 125 years ago, put away a couple bucks in the Dow, and look at this beautiful chart showing how much it'd be worth today. And I think while you see a couple of periods where you've got, 10 years of nothing or 15 years of nothing because the market had some dips, it's a beautiful chart if you were to invest at that time and just leave that money there for 125 years.
Yeah, if I could, we joked about it before. If we can get clients to fall asleep for 5, 10, 15, 20 years, they'd probably be happy with the outcomes. It's just long-term periods of time are made up of a bunch of short-term periods of time.
Sure. But I think, you look at it and over time, you started with less than 30 companies. Those 30 companies have all rotated several times. You don't have any of the original 30 in there anymore. The Dow started at, a ratio of around 10, and it's north of 30,000 today. So you've got to say, man, what a ride for that 125 years.
I agree totally that the ride has been wonderful. Similar to, again, investing in markets is usually a winning proposition. I will also tell you that, I'm not a fan of the Dow. Do you know Amazon? The company Amazon?
Yeah.
Yeah. You know what company is not included in the Dow?
Amazon?
Amazon. So, United Healthcare, the company that is about half the size of Apple, they have the same weighting almost in the Dow.
But true or false, if you had a buck to put in the Dow 125 years ago, you'd be pretty happy with your investment.
Yes, of course. And I think it's two separate things. Your point is well taken. Yes, human economic ingenuity is a good bet. Absolutely. Even if it's only 30 companies that are non-representative of the economy that you're trying to invest in.
So let's shift to the S&P. Okay. Is that a little better benchmark? Okay.
It's better. It's not the Russell 3, but it's better.
Better. Okay. So we're now talking about 500 companies in the US. We're not talking about foreign, but still it's a pretty good representation of the US stock market. And I have a chart pulled up here, which shows all the bull and bear markets over time, going back, almost 100 years. And I think what's amazing to me is that these bear markets are so short, they're so brief, and then they're followed by the bull markets thereafter. And you and I always have clients that, whether they've sold the business, sold the house, received an inheritance, where they say, I want to invest, but why do I want to invest now? Because the market's so rich. And the comment is always, what goes up must go down. And to me, it's almost the reverse. It's almost what goes down must go up by more, right? Because the upward levels are so much higher than the downshifts.
Yeah, it's, when you look at it graphically, every single downturn that the market has experienced always looks like an obvious buying opportunity.
Right.
The problem there is that we're not econs, we're not spreadsheets, we're not walking wallets, we're human. And it feels like the world is coming to an end while you're living through those downturns. So once you're out of it, it's, oh wow, what an obvious buying opportunity. And I say this a ton now, especially because I saw this with my son. As we were looking, he ended up investing in an ETF or two, and we're looking at a chart like this, and I'm pointing him to the great financial crisis. And the first thing, because I've coached him into this, he's like, oh, I would have bought for sure. And I'm like, it's funny you say that, but oh man, is it just absolutely challenging emotionally to pull the trigger.
Well, not only that, but then when you come out of it, it seems like every year thereafter during the bull market, you're constantly worried, when is this going to end? When's the next correction coming? I mean, how many times have we heard over the last 10 years, we're going to have a pullback, we're going to have 10%, 20%, 30%, whatever it is. And I think we'd all love to be able to get out during those corrections, right? We know that market timing is impossible, but I don't think you need a time, right? I think what this chart shows is that if you could just get on this ride And if you had to tolerate a 10, 20, 30% drop every decade in exchange for a 500%, 800%, 900% gain in the following decade, you'd take it all day long, right?
Yeah, easy. And it's the other challenging part is if you miss a portion of that upside pop, which
Right.
is usually the big ones are really close to the big drops, that's forever lost, right?
Right.
You can't recover that. And that's why I think you consistently tell clients, and I consistently tell clients, our job is not to make sure you avoid those drawdowns, but to make sure you're participating in those draw ups, if you want to refer to it that way.
I tell
Absolutely.
clients an analogy I use where, imagine you're trying to get from Florida to California in a road trip, and you're in your car and you get only a few miles out of town and there's a huge backup on the road. And you've got a bike in the back of your car, and you take out your bike and you say, I'm going to get around this traffic. I can't sit here for hours. Who knows when this will be cleared up? So you get on your bike. That's the equivalent of going to cash, is that instantly you feel better that you're not in this wreck, that you're not in this downturn, that you're not in this panic. But then you realize a bike's not going to get me to California, right? I'm going to probably been better off just sitting in my car, waiting this thing out, and then doing the other 100 or 1,000 miles out there, by car, because I'll get there a lot faster.
Yeah, that's a good analogy. Just turn on the podcast and sit tight. I would never drive from Florida to California. That sounds like an absolute nightmare. I don't know how many hours that is. It's too many. I think Josh drove to Seattle, right? That was one of the possibly worst decisions I've ever conceived of.
Well,
a drive like that is just not possible.
You had a few months and you could go see the sights, and you could stop at Mount Rushmore and New Orleans and Texas and different places.
I guess, yeah. That would make it better. I don't like long car rides, Brett. You know this.
Well, yeah. I mean, the dogs would be uncomfortable too in the back seat along with your children.
No, so I guess we'll end it here as we show our true selves. The only time we've done a long car ride with a dog, we gave him Xanax. And what's funny about that is when my wife, Schaefer, went to go fill that prescription, they saw a 3-year-old that was taking about double the normal dose of an adult for Xanax. And the pharmacist was like, I can't give this to you. Your child can't take this. And she's like, oh, no, it's actually for my dog. So there you go.
Well, I should say I forgot to include in our conversation before my blow your mind inflation metric that I wanted to share with you. So I don't think most people know this. I've been doing a lot of research on inflation recently. And I don't know if you realize that we mostly think about food and energy as the cause of inflation. That's what we see all day long, right? You see the gas prices, you see what's going on in Publix and supermarkets. I don't think people realize that services, whether that's trash collection to your dogs, to the internet and Netflix, to education, to babysitting, to getting your hair cut, services make up 60% of the inflation number. So by far and away, what's going to move that inflation is going to be what we all pay when we go and do our daily activities and meet other people.
That's interesting.
So,
okay, 60%. I didn't appreciate that. Good stat. And I guess that's why they do core inflation versus non-core inflation, right?
Right.
Okay. All right. I think we end it on that. That's a good stat. Thank you, Brent.
Okay. Sounds good. So let's do it again some other time.
Always a fun time. BH. Thank you, man. Talk soon.
Have a good day.
Bye.